Hello, everyone. Thank you for joining us today for our second in a series of monthly webinars on behalf of the National Disability Institute's new Center on Disability Inclusive Community Development. I am Michael Morris, the Executive Director of the National Disability Institute. I'm joined here in Washington, D.C. with Mark Reichert, who is serving as the director of the new center. You will be hearing soon from our guest presenter, Dori Rand from the Woodstock Institute. But before we move ahead, I'm going to turn it back to get a few of the logistical issues resolved and turn it to Katie.
Thanks, Michael. Listening to today's webinar, the audio for today's meeting can be accessed using computer audio or by calling in by phone. If you select computer audio, please make sure your speakers are turned on or your headphones are plugged in. If you do not have sound capabilities on your computer or prefer to listen by phone, dial 1-929-205-6099 and enter the meeting code 189-056-033. Captioning. Real-time captioning is provided for this webinar. The captions can be found by clicking on the CC button in your Zoom controls at the bottom of the screen. If you do not see the captions after clicking the button, please alert the host via the chat box. You may also view captions in your browser at http://www.streamtext.net/player?event=NDI. Submitting questions. Please use the Q&A box to submit any questions you have during the webinar, and we will direct them accordingly. If your question is not answered during the webinar, or you are listening by phone and not logged in, you may email kauchenbach@ndi-inc.org. For technical assistance, if you experience any technical difficulties during the webinar, please use the chat box to send a message to the NDI host, or you may email that same email, Katie Achenbach, KAUCHENBACH@ndi-inc.org. Please note, this webinar is being recorded and the materials will be placed on the National Disability Institute website under Resources and then Webinars. And I'm going to turn it back over to Michael to get us started for today.
Thank you, Katie. Thank you for so many of you joining us today. For some of you, this may be your first webinar with the Center for Disability Inclusive Community Development. For others, I hope you joined us last month where we had our inaugural webinar. In either case, we're glad you've joined us. Last month, we had over 400 people from across the country participated with us, representatives from the disability community, from the financial world, from government agencies at multiple levels, and we had a great start to explaining why are we creating this center and what our goals are and what you can expect from us over the coming months with this being a part of our education and outreach activities. We're going to go over some of this again for those of you who are new to visiting with us. First is, what's the goal for the center? The goal for the center is to improve the nationwide financial well-being of low and moderate income persons with disabilities and their families. A major focus of our work will be on the current state of implementation of the Community Reinvestment Act, but we also will look beyond CRA at other ways that banks and other financial institutions and those in the financial sector can become involved in this priority for all of us, and that is inclusive community development to improve the economic stability and security of low and moderate income people with disabilities. If we go to this next slide, primary purposes, we have two primary purposes for the center. The first is to raise broad awareness within the disability community about the opportunities for capacity building available through investment, lending, and services offered by banking institutions as part of their CRA responsibilities. And a second primary purpose is to foster greater connectivity between the financial services sector and the disability consumer and service provider communities well suited to collaborate on inclusive community development activities. If we go to the next slide, I want to share with you as well, what do we see as we've just begun with this new center? What are some of the principal outcomes we expect to be achieved over the next 12 months and beyond? The first is that community-based disability service organizations will gain a better understanding of the investment, lending, and service opportunities open to them as they consider how to best fashion CRA qualifying community development activities meeting the unique needs of low and moderate income people with disabilities. A second major outcome we are striving to achieve will be that financial institutions will be better equipped to recognize and evaluate disability-related community development proposals as CRA qualifying projects and activities. And then a third principal outcome is that we hope to, in our education efforts, to also work with federal regulators. There are 3 regulators under CRA, the FDIC, the Federal Reserve, and the Office of Controller of the Currency, OCC. We work with all 3, and we hope to work over the next year to improve their awareness and understanding so that they can better be prepared to evaluate financial institutions' CRA performance in a way that is truly disability inclusive. If we go to the next slide, who are our target audiences? The first is low and moderate income persons with disabilities so that they have improved access to mainstream financial services that will allow individuals to improve financial stability and mobility, which will be enhanced by center education, training, and technical assistance activities. The second target group is financial institutions. The center will seek to increase access to a growing market share of people with disabilities that are more likely to be unbanked or underbanked, or even to have access to a savings account. Technical assistance will be available from the center to support financial institutions in identifying and developing their performance context in their primary assessment areas and connections to nonprofits that support low and moderate income persons with disabilities and their families. The next slide, please. There are 3 other target audiences. So in addition to those first 2, the third group is community-based organizations serving LMI persons with disabilities and their families. The center will strive to offer technical assistance that will result in support of CRA projects from financial institutions that increases funding and capacity to build the financial wellness of low and moderate income persons with disabilities and their families. Target audience number 4 is community-based organizations serving low and moderate income populations in a general way, not so much targeted to people with disabilities. We're interested in also targeting technical assistance from the center to support you, community-based groups that serve low and moderate income populations may not intentionally be focusing on low and moderate income people with disabilities, but they're probably within those that you serve. We hope to expand the attention to that group and the reach to that group by expanding your programs to include persons with disabilities and their families. And the 5th and final target audience are federal regulators, as I mentioned in terms of our primary objectives. Again, as I mentioned, 3 primary financial regulators of banks, OCC, FDIC, and the Federal Reserve. And we expect to offer expert advice and guidance to all 3 federal regulators about what we learn by working with all of you and others across the country about inclusive community development, with a particular attention with our researchers here at NDI. What data is available to help identify low and moderate income people with disabilities within low and moderate income neighborhoods, and how do we bring that data forward to financial institutions so that you can better assess and identify ways you could meet your CRA obligations by really targeting low and moderate income people with disabilities and neighborhoods. So I hope for those of you who are new, this is your first webinar with our new center. I hope what I've just shared with you will help you better understand why we are moving forward with this webinar series, some of our objectives, our target audiences, and goals for the coming year. I want to next introduce to you our featured presenter this month. Our presenter is Dori Rand, who is the president of Woodstock Institute, based in Chicago, where she oversees the nonprofit's research and policy advocacy on equitable lending and investments, wealth creation and preservation, and access to safe and affordable financial services at a local, state, and federal level. Dori serves on the Financial Advisory Council for the Empowerment of People with Disabilities that has been convened by the Chicago Mayor's Office for People with Disabilities in cooperation with the Office of the City Treasurer. She also serves on the board of directors of the National Community Reinvestment Coalition, many of you know it as NCRC, and on advisory councils for Capital One, Fifth Third Bank, JP Morgan Chase, and others. She previously served on the Federal Reserve's board's Consumer Advisory Council, the Consumer Financial Protection Bureau's Consumer Advisory Board, and the State Banking Board of Illinois. Dori has a law degree from Ohio State University, and prior to her work at the Woodstock Institute, many of us around the country worked with Dori with her leadership at the Shriver Center on Poverty Law. So I'm really excited and thrilled that for this second webinar in our series, for the new Center on Disability Inclusive Community Development, that we have Dori Rand to talk with you. Dori is going to start with a PowerPoint, and then we're going to turn to questions that Mark and I have pre-prepared for a conversation with Dori. But throughout her presentation, as well as when you hear questions and the answers from Dori that will follow, please don't hesitate to use the chat box. We will try to get to some of your questions as well. The ultimate goal here is that all of us become more informed about how CRA can be used to meet the financial needs of low and moderate income people with disabilities. A topic that we hope with this new center to put a spotlight, a laser focus on this population, which certainly does qualify as a targeted audience under CRA, but there is a lot more that can be done than we have seen so far across the landscape of financial institutions and in terms of the oversight and policy guidance from the federal regulators. So with that, let me turn to Dory, and again, thank you for being with us. And I believe we'll move Dory's slides for her. Okay. Dory, please take it away.
Thank you, Michael, and good afternoon, everyone. I'm really pleased to join you today, and I have been a long time and big fan of Michael and the National Disability Institute, and I'm very excited about the new center, so congratulations on that. So let me give you a little bit of background, next slide please, on Woodstock Institute. I've been the president here for 11 years, but I've been working on Community Reinvestment Act issues for about 20 years. And Woodstock was involved at the very beginning of the creation of the Community Reinvestment Act when Senator Proxmire's staff came out to the conference center in Woodstock when they were writing the law. So we have a very close history on that. After starting as a conference center in Woodstock, became a regular 501c3 nonprofit based in Chicago, and have done our work, as Michael said, at the local, state, and national levels for 45 years now. Our mission really is to make our financial system more safe and sound and inclusive, especially for low and moderate income people, people of color, people with disabilities, and other protected classes who often are left out of our mainstream financial system and end up paying a lot more to do business outside of the mainstream, and as a result, having fewer opportunities to build wealth and economic security. So the way we go about our work is to do research, to use the findings to direct policy recommendations to the policymakers and the banks and others who have power to make changes, to work in coalition with other groups around the country, and to provide technical assistance. So I'm happy to share some of that with you today. So let's go to the next slide and talk a little bit about why the Community Reinvestment Act is important. It's critical to have access to mainstream financial services in order to build wealth and have financial security. We know that most Americans have their greatest amount of assets in home equity through home ownership, but there are other ways to build wealth, like owning a business, saving for retirement, getting an education that then lets you get a better, higher paying job, things like that. So having access to safe, affordable, trustworthy financial services helps us do all of those things. And when we don't have access, we find that there's a growing wealth gap between the higher income people, the people who are not people of color, who do not have disabilities, and we think that using the Community Reinvestment Act can help us close that gap. So next slide, please. So a little background on the CRA. It was enacted by Congress back in 1977 in response to redlining and racial discrimination and discrimination against lower income people in our financial system, both by the government and by mortgage lenders. And the folks at Woodstock Institute and others urged Congress to create this law to broaden access so that people could become homeowners and live in the neighborhoods where they wanted to live. Under this law, banks with federal deposit insurance have an ongoing and affirmative obligation to serve the financial and credit needs of low and moderate income people and communities. and they are examined on a periodic basis by the federal banking regulators, who Michael mentioned, the OCC, the Federal Reserve, and the FDIC, and that helps hold them accountable for meeting their CRA obligations. In addition, when they're examined for their compliance with CRA, the examiners also look at whether they're violating any consumer protection laws or fair lending laws. So when they issue their findings of the examinations, the regulators give one of 4 ratings: outstanding, satisfactory, needs to improve, or substantial noncompliance. And the reality is there's a lot of grade inflation, and well over 90% of all of the banks get a satisfactory or higher rating on their exams. It's relatively hard to not get a satisfactory rating. But there are a lot of ways that we can work with banks and the regulators to try and focus more clearly on the requirements, on community needs and whether the banks are meeting them, and making sure that they get the accurate rating that they deserve. The way that the examiners do the performance evaluations or the exams is to apply particular tests based on the size of the bank's assets. And I don't want to get into too much of the weeds here, but there are 3 categories: large, intermediate, small, and small banks, and the tests vary somewhat depending on the size of the bank. But we'll use as an example the large banks, those with over $1.284 billion in assets, that provide about 80% of all the banking services in this country. And in that case, the exam covers a lending test, an investment test, and a service test. So let's, don't go to the next slide yet. And along with the retail banking service test is also a community development services aspect. In the smaller bank tests, they don't have the 3 separate tests. In the intermediate small bank situation, you have a lending test and a community development test, and in the small bank test, you only have a focus on lending. The reason that the rating is important is because if a bank does not get at least a satisfactory overall rating, then the regulator may not allow them to open or close branches or acquire or merge with another bank, and so it really prohibits the bank from moving forward with the business they might otherwise want to do. So that's the leverage. Most of CRA is a carrot. That's the stick. If you don't get a satisfactory rating, you might not be able to open and close branches or merge or acquire other banks. So let's go to the next slide. I wanted to share some resources with you all for where you can find more detailed information about CRA. There are a lot of good places to look. FFIEC.gov has a wealth of information, including the CRA statute, the CRA rules of the 3 prudential regulators. In addition to the rules, there's a whole series of questions and answers, or Q&As, that really flesh out the rules and provide a lot of guidance to both the banks and the community groups as to what counts and how things are measured under CRA. And then there's the exams themselves. Sometimes it's a little tricky to find the exams on the website because you have to know which regulator did the exam for the bank. If it's a national bank, you know it's the OCC. And then if it's not a national bank, if they're a member of the Federal Reserve System, it's the Fed. And if they're not a national bank and not a member of the Federal Reserve System, it's the FDIC. But you don't have to memorize all that. You can find it through the FFIEC. And also, if that's too hard, you can contact your local regulator. There are offices around the country of each of the 3 regulators, and ask the community affairs staff to help you find the latest CRA exam, or you can ask the bank itself, and the bank should be able to provide that to you quickly. In addition, each of the regulators has a website. I've given you the website addresses for the Fed, the OCC, and the FDIC. A lot of good information there. And then also, as Michael mentioned, I'm on the board of the National Community Reinvestment Coalition. It has been the main membership group promoting CRA for 25 years. There's a lot of good information on its website, ncrc.org. And in addition, it has a research team and a team of regional organizers covering every part of the country who can help answer questions or find information for you. And there's an annual conference that I highly recommend. I've been going to it for about 20 years now. It's always held in Washington, D.C., and we have wonderful speakers, including the regulators and other policymakers, and folks from all kinds of organizations all over the country, and bankers and researchers all gather to learn from good workshops and present and network. So our next one coming up is in April of 2020, and there's information on the NCRC website about that. The other thing I would say about NCRC is many of us, like me at Woodstock, lead local coalitions. Other places around the country have statewide CRA coalitions or citywide CRA coalitions. So there's plenty of ways to connect with people who have experience in this if you're a newbie. Next slide, please. So how can you have input into the CRA process and to share the information that you have to raise awareness about the needs of people with disabilities? It's important to know that you don't have to wait for a specific event to happen to reach out and have contact about CRA. You can do it at any time you want. You can contact the bank directly. You can meet with the bank. You can send the bank a letter and ask that it be kept in its CRA file. You can contact the bank's regulator in your region, send the regional regulator a letter. You can also send letters or go to meetings with the regulators in Washington, D.C. Michael and I were just at the OCC last week. And besides commenting in general on the needs of your community or the needs of your particular population, you can comment on how well you think the bank is meeting those needs or not meeting those needs. You can comment on whether the bank has an adequate number of branches and ATMs in your area, whether they have opened or closed branches to benefit the community. And one way to keep track of all this information, if you're an NCRC member, the team sends out quarterly lists of all the upcoming CRA exams, all of the pending mergers, and all of the branch closings. So you can get good information that way and follow up on a regular basis. Next slide, please. So one of the things that we've been using very successfully under CRA is the idea of a community benefits agreement, or a CBA. The way that this often works is in the context of a bank merger where the merger process is open to public comment, and if one or both of the banks in the merger or acquisition are not doing top-notch CRA level work, you can share that information with the bank and with the regulators, and you can also ask the bank to engage in a process to develop a community benefits agreement. This has been going on for decades. The first time I did it was back in 1997 when Bank One was acquiring First National Bank of Chicago. And at the time, I wasn't at Woodstock Institute, but Woodstock Institute was coordinating the Chicago CRA Coalition, and we got a group of advocates together, including Access Living, which advocates for people with disabilities, and we negotiated a very comprehensive agreement with the acquiring bank that covered 6 years with detailed goals and measurements for lending, for services, for investments, for branches. And at the time, it was the biggest community benefits agreement ever at $4.2 billion. That's now been dwarfed many times over. But it was a regular thing that groups did, especially back in the 1990s after the CRA rules changed and became more clear. So in recent times, National Community Reinvestment Coalition and others have negotiated community benefits agreements, both in the context of mergers and in other contexts. So in the merger context, a couple of the recent ones were the BB&T, I'm missing a B in the slide there, BB&T and SunTrust merger. They created a community benefits agreement worth $60 billion over 3 years, the largest ever. A couple years ago, I was involved with a community benefits agreement involving Huntington Bank as it acquired First Merit in the Midwest and including the Illinois area. That was worth over $16 billion over 5 years. There was a similar one by KeyBank out of Cleveland, covering over $16 billion worth of lending and investment commitments. And then in a different context, Fifth Third Bank approached Woodstock Institute and NCRC after it had been downgraded to a needs to improve rating through the CRA process. And they were aware of these CBAs with other banks and saw how that process worked and said, could we do a similar CBA even though we're not in a merger context? And we said, sure, we'd love to do that with you. So Fifth Third Bank has branches and service areas across 10 states, including the Midwest where I am. And each of those regions had meetings to participate with the bank and come up with a very comprehensive agreement that was for 5 years and $30 billion, which at the time was the largest ever until the recent BB&T SunTrust merger. And then since then, we're still in the 5-year process with Fifth Third. They acquired MB Financial Bank here in Chicago and added another $2 billion to the pot. And what happens in each of these cases is, in addition to having a very detailed written commitment of what the bank's going to do in various geographies and at what dollar amounts and what products and services they're going to offer, they set up community advisory boards in the different areas to meet with on a regular basis, usually 2 or 3 times a year, to report back on how they're doing against those commitments, whether they're reaching those goals or whether adjustments need to be made. And it gives an opportunity for the community members to hold the banks accountable and to continue to provide information on community needs and whether things are measuring up or not. So next slide, please. So aside from the community benefits agreements, in general, the Community Reinvestment Act can be used to leverage investments or lending for a very wide variety of things, as long as the primary benefit, meaning over 51%, is to low and moderate income people or communities. So in this slide, I provide some examples. This is not an exhaustive list by any means of the kinds of things that banks have provided money for, either through grants or loans, that count for CRA credit. Almost every bank has some kind of financial education or financial coaching program, but there are also a lot of really good housing counseling and first-time homebuyer programs, foreclosure prevention programs that were critically important after the crash 10 years ago. It can also be used to cover workforce development and training for low and moderate income people, entrepreneurship and small business development and technical assistance, stuff like what Woodstock does, research, having a data portal, providing TA to community-based organizations. There's also been CRA credit for things like age-friendly banking, targeting services to low and moderate income people with disabilities. And also, banks can get CRA credit for supporting community development financial institutions or mission-driven lenders or CDFIs who make mortgage loans or small business loans or provide technical assistance. Often they fill a gap that the banks can't do a really small dollar loan, but the CDFI can, and the bank can give the CDFI a loan or an investment or a grant to support the work that the CDFIs are doing. And then sometimes after the CDFI has served those customers, say it's a small business, they could get up and running for a few years, have a couple years of profitability and financial records, and then be in a better position to go back and qualify for a bank loan. So as Michael and I learned at the meeting at the OCC last week, the regulators are in the process of developing a much more comprehensive list than the one I've given you on this slide, so that everybody could have a clearer understanding of what counts for CRA. But we don't have access to that quite yet. Next slide, please. So I want to mention a couple opportunities for advocacy. The reason that Michael and I were at the OCC meeting last week is that the federal regulators are considering some significant updates and changes to the CRA. Last year, the OCC on its own issued an advance notice of proposed rulemaking with a number of ideas and questions about how CRA might be changed. Now this year, we're expecting the OCC and hopefully the other regulators, the FDIC and the Federal Reserve Board, to issue joint proposed rules that will be open for public comment about updating and modernizing the CRA. And I hope that all of you on the call will get involved in this, because they haven't been updated for 20 years, and they're probably not going to be updated again in a significant way once this process is over. So this is a once in 20 year opportunity to have input on CRA rules. I really want to congratulate Michael and NDI and the co-authors on the paper they did that's cited in the slide, Closing the Disability Gap. It's a really great analysis of CRA and how it can be used to meet the needs of people with disabilities. I hope all of the regulators are reading it. And that paper mentions a number of different ways that CRA could help people with disabilities. I'll mention just a few of the kinds of products or services that could qualify here. Many of you are probably familiar with bank-on products. These are accounts that are certified by the National Cities for Financial Empowerment Fund, CFE Fund, as meeting a set of criteria that make these accounts very safe and affordable. And one of the key features of the bank-on national accounts is that they don't have overdraft, because overdraft can be a real debt trap. It sucks billions of dollars a year out of consumers' pockets, and We think for a starter account or for people with limited income, having an account that doesn't have the ability to trap you in overdraft is really important. So there are a number of banks who already offer bank-on accounts, but a lot more could and should. It's one of the things that you could advocate with them to do that would help not only people with disabilities, but a lot of the unbanked and underbanked population that's still over 9% in this country. Another thing that's more specific to people with disabilities is the opportunity to get banks to provide loans for home modifications for accessibility. If somebody is using a wheelchair and they need a ramp, or they need wider doors, or they need grab bars in the bathroom, or lights at a lower level, or kitchen modifications, there's a lot of things that can be done that allow people to stay in their community and not have to go to an institutionalized setting, and banks can facilitate that by offering those kind of home mod loans. Banks can offer loans as well for things like assistive technology. If somebody can get a type of technology that would allow them to work or work from home, that could make a huge difference in someone's life. Another thing we've heard about is the importance of making sure that bank websites are ADA compliant, that is, that they comply with the Americans with Disabilities Act, and also that their brick and mortar physical facilities are compliant, as well as having ways to access their phones and their ATMs for people with different kinds of disabilities or challenges. So that's just a couple of examples, and I'm sure Michael and Mark in their paper address a lot more. The other thing is, as Michael mentioned, various cities like Chicago have started groups to promote financial inclusion for people with disabilities, and we're hoping to get to the point here in Chicago where we can start meeting with banks who do business here to raise awareness and to see if we can get their cooperation in offering more of these products and services that meet the needs of people with disabilities and their families. Next one. Oh, I forgot to mention something. Can you go back once to the earlier slide? I forgot to mention the possibility of changes at the statute level to CRA. So what I was discussing before is changes by the regulators to the rules, but not to the law. In order to change the law, Congress would have to do that, and there have been some proposals raised, including by Senator Warren and Representative Richmond, that would provide a wide range of changes to housing affordability, but would also strengthen the Community Reinvestment Act and make it apply to more financial institutions than those who take deposits. As I mentioned before, right now CRA applies only to institutions with FDIC insurance. But now over half of all mortgages are made by non-bank lenders and companies that don't take deposits. And as a result, CRA doesn't apply to them. So bills like the Warren bill would help expand the applicability of CRA and the range of institutions that would have these obligations and could provide support to people with disabilities. Okay, next slide, please. So I know a lot of the questions that Michael and Mark wanted me to address are involved with how do you do a bank partnership. I've been involved in a number of different bank partnerships over the last 20 plus years, and I don't think there's one right way to do it. There are a lot of different potential ways you could do it, and it just starts with reaching out, I think. You can just call up your local bank and ask to speak with the CRA officer or ask for a meeting with the CEO. You can contact your local regulator in the regional office and ask to talk about whether there are any events coming up where you might be able to network with banks and other community groups. You just have to, it helps if you have an introduction, but you don't have to have an introduction. It's fine to do a cold call and start from there. And usually I think banks will be open to at least having a phone conversation or having an initial meeting. And they're always interested in trying to find ways to serve community needs and get CRA credit. And I think your goal is to find a win-win. You raise the issues of community needs and the needs of people with disabilities. The bank tells you what kind of things they're interested in supporting or what geographies in which they need CRA credit, and you try to find a solution or a partnership that serves the needs of both sides. And oftentimes the bank community affairs staff can help you talk about that. So as I mentioned earlier, in order to get CRA credit, your program or activity or service needs to primarily benefit low and moderate income people. It doesn't have to 100% benefit LMI people. Ideally, the geography where it happens should be in what's called the bank's assessment area. And that includes the areas around the bank's headquarters and physical branches. And it can also include areas where there aren't physical branches, say for an online-only bank like Ally Bank. In that case, the bank will designate an assessment area that includes their headquarters and some geographies where they do a significant amount of business. This is one of the areas that we hope will be clarified in the new CRA rules and or in new CRA legislation because it really hasn't kept up with the changes in technology and the fact that we have online-only banks now. The last time the CRA rules were updated, we didn't really have internet banks. So the bank is going to want to primarily support programs that are in their designated assessment areas, but if they can show that they've already adequately met the needs of the community in their assessment area, they can also support programs that are outside of their assessment area. But when the regulators do their exams, they are going to look to see what the distribution is of their loans and services, and at least 50% should be within the designated assessment area. Another way that you can partner with banks is to invite one of their staff to participate on your board of directors if you're a nonprofit. And it's very common for bankers to do that. Oftentimes they serve in a treasurer role or a role that uses their financial expertise. And many times banks also look for opportunities for their staff to volunteer. Even if it's not to be a board member, you might have a kind of program where you do something in the community and they can have their staff come out and help stuff backpacks for school or paint a building or something like that. But ideally, you want the kind of activity that is going to allow the bank staff to use some of their financial expertise to help your organization. Of course, the banks appreciate public recognition. It's good for their reputation if there's some way that you can acknowledge their help or present them with an award or have some kind of media coverage of your event. They seem to like that in my experience. One thing to be aware of is some banks have carved out very specific areas in which they wish to do their CRA work or their grant making, and your particular group or constituents may not fit that bank's criteria. Or the bank may say, you know, we're a small bank, we only have a very small budget for grants. We've already decided, you know, how many X dollars we're going to give out this year, and we don't have any left. So I've run into those kinds of walls before. It may happen to you too, but you can get a lot of background information usually from the bank's website and from talking to their CRA officer and finding out what kind of areas they are interested in and what their application process is. If you're looking for a grant, if you're dealing with something like a loan pool, that's different. Then you would go through a different process. But what I'm talking about here primarily is about getting grants that you don't have to pay back. Okay, next slide, please. So this is the modernization I was talking about a minute ago. We're very concerned that some of the ideas proposed in the initial and advance notice of proposed rulemaking by the OCC would actually weaken the CRA and result in less investments and lending and services in low and moderate income areas. And so we think it's very important that we stay true to the legislative intent of CRA to serve local community needs and to enforce CRA in a way that gives real attention to those community needs first. And we also think it's important that all three of the regulators issue the CRA rules jointly. One of the things that happened in the past leading up to the financial crisis was that a fourth regulator that doesn't exist anymore, called the Office of Thrift Supervision, or OTS, had changed its policies in a way that really caused a race to the bottom. Banks were changing their charter to the OTS based on a promise of less supervision and regulation. And we think having different standards among the three regulators is very problematic and did not work out well in OTS situation. So we think having consistent rules across the three regulators would make it a more stable environment for both the banks and the communities they serve. We're definitely in favor of increasing the clarity and the certainty of what counts for CRA and where it counts and how it's measured. We do have some concerns and differences about some of the proposals that have been put out there about how to measure CRA compliance. So I'll just give one example. In the OCC's proposals, they have talked about using financial metrics as the first test, which would monetize every CRA activity, make that a numerator over the bank's assets as a denominator, and then based on some preset formula, decide whether or not that dollar amount met CRA requirements. And then only after getting that presumptive CRA rating would the OCC consider the local community needs. As I said in the meeting that Michael and I attended last week, we think that's really backwards and wrong way to approach CRA. We think community needs has to come first, the performance context, and only when you know what the local community needs are can you assess whether the bank is meeting those needs under the CRA. We also have concerns about branching. There's been a lot of consolidation in recent years, a lot of branch closings, And we think for some people, using technology works really well. They have internet, they know how to use it, they can afford to pay for internet subscriptions, they can afford to have computers and smartphones, but that's not everybody. And a disproportionate number of people who don't have broadband and internet and computers are low and moderate income people and older adults and people with disabilities. So we want to be sure that we continue to emphasize the importance of having physical branches and ATMs in communities in addition to alternate service delivery. And when there is alternate service delivery, we want to make sure not just that it's available, but that it's effective for LMI people. Next slide, please. So one of the things that the Federal Reserve banks did was hold a lot of meetings at the local level to get community input on the CRA rule changes and what people would like to see happen. And I've just given you a couple sites here from the report that summarize those meetings. I had a chance to participate in the meetings here at the Chicago Fed. And one thing was the continued importance of physical branches and geographic distribution. The other thing specifically mentions the needs of people with disabilities, the underserved, minorities, immigrants, and others. And we think that going forward, the banks should pay more attention to these subgroups of low and moderate income people who are disproportionately affected. All right, next slide, please. So we talked about the statute modernization. This is the site to the Warren bill I mentioned, the Affordable Housing and Economic Mobility Act of 2019, the Senate version and the House version. Of course, we don't think this is going to happen with the current makeup of the U.S. Senate, but we think there's potential for that bill advancing in future years. Next slide. So I mentioned a little bit about technology, and I don't mean to be a naysayer about technology. I think there's a lot of good that can happen through financial technology or fintech, including ways to help with people with disabilities access financial services and jobs. And one of the things that's happening with financial technology these days is the idea of real-time payments or faster payments. Already several other countries have adopted faster payment systems. Usually it's been government mandated and government implemented. We've had a different process so far here in the United States. The Federal Reserve Board convened a faster payments task force that I participated in for a year and a half, and it developed a whole series of criteria by which proposed faster payment systems should be judged. And one of the reasons I wanted to participate in that task force was specifically to make sure that whatever system is developed, that it is inclusive and inclusive of everybody, including people with disabilities, including the unbanked, including low-income people. And I was very pleased that through the Fed process, we ended up with a set of criteria that did adopt those requirements to make any such system really ubiquitous and open to everyone. We're now at a phase where the Federal Reserve Board has indicated that it intends to go ahead and create a financial system through the Fed. Back when I was on the task force, the idea was that private industry would be able to create a system that worked for everybody. But what happened was the only big systems that have been created so far are owned and operated by the big banks, and they are not necessarily available to everybody. For example, you have to have a bank account in order to use the system. So if you're just somebody, if I'm Dory in Chicago and I have cash and I want to be able to send money to my sister in Columbus, Ohio, electronically, if I don't have a bank account, I can't do it through the industry system. But ideally, through a truly inclusive system, there would be a way, even for unbanked people and people with cash, to access that system. The other point I'll make about faster payments is that I think a huge benefit of a faster payment system would be to eliminate the ridiculous overdraft fees that so many people pay now. If people had accurate information about exactly how much money is in their bank account at a given time, instead of waiting for several days of float before checks are deposited or money is transferred, it would reduce the likelihood of overdraft and save people literally billions of dollars. So we're still several years away from faster payments, but it's something to look forward to, and I think if you have an opportunity to participate in making comments and to raise the issues that affect people with disabilities, I would encourage you to do so. Other aspects of fintech that you've probably been hearing about or reading about include use of artificial intelligence or machine learning and algorithms that take a bunch of information and put it through a computer and spit out a result that you're not quite sure how that result was created or whether that algorithm is fair in the way that it analyzes that data. And what we're finding is that a lot of times artificial intelligence and machine learning and these algorithms continue to replicate discrimination that we already have in our existing systems. And we really need to find a way to root that out and make sure that whatever new technology is used, that it's used in a way that is fair and does not discriminate. We've also heard a lot about privacy breaches. If you haven't checked to see if the Equifax credit bureau affected you, I highly encourage you to do that. I checked mine and my name was in there. So you can sign up for free credit monitoring and make sure that the people who got access to your personal information are not using it to ruin your credit record. Also, I would throw in that you should take advantage of the annualcreditreport.com website to check your credit reports from each of the three major bureaus on an annual basis. There are often errors in there, mixing you up with other people and potentially hurting your credit and hurting your ability to get a loan or a loan at a good interest rate. The last thing I'll say about fintech is that at both the state level and the federal level, there have been proposals to create so-called sandboxes or regulation-free areas for financial technology innovators. And the idea is that in order to encourage innovation, we need to let people experiment without having to comply with the usual fair lending or consumer protection laws. We think that's a very bad idea. We think it's possible to do innovation and try new things without eliminating liability for law violations, and have strongly encouraged the regulators not to do that. But states like Arizona and Utah and another one I can't remember have already passed sandbox laws. They've been introduced in Illinois a couple times, and they may be coming around to a state near you. And I hope that you'll pay attention and make sure that consumers are not guinea pigs in these experiments, and that if they're going to experiment on consumers, that they still have to comply with the law and make restitution for any harm that they cause. All right, next. And that's it. I hope that wasn't too much information, but there's a lot more you can find out through some of those resources I mentioned. And now I guess I'll welcome questions from Michael and Mark.
Thank you, Dory. Tremendous presentation. I feel like we should probably hold an exam now with testing people to have they absorbed an immense amount of information. But you really laid out not only help beginners being introduced to CRA, but really how to be involved with banks, understanding more the role of regulators. Wonderful. So Mark and I have some questions for you. Some will kind of reaffirm some of the points you made. So let me jump in. Number one, where would a community group begin to become involved with the bank in their physical footprint, specifically to learn more about what's the status of the bank in their local community, their current evaluation report from regulators? Where would one go?
Sure. So I would first try looking at the ffiec.gov website. And if you can't get the information you need from there, then I would contact your local community affairs staff at your regulator, or ask the bank directly, send me your latest CRA exam, or contact NCRC in DC and ask their CRA team or their regional organizer to help you get that information.
Great. And a second part to this question is, obviously, there's a lot of money that's being expended by banks annually. I think when we were at OCC, the most recent figure, I believe they cited last week in 2017, I believe the figure was over $400 billion that was expended. If you're with a nonprofit, obviously whether you're in a city or somewhere else, how do you begin a discussion about either lending service or investment opportunities that might be of mutual interest in a low moderate income neighborhood with your local bank?
Sure. Well, one way is to look at what the bank's already doing. So the bank often will have information on its website about community investments or about CRA. As I said earlier, you could also just ask for a meeting or a phone call with the local CRA officer of that bank. You could also ask the community affairs staff at the local regulator to make an introduction or invite you to a meeting that's happening with them. So you want to know both what the bank's already been doing, what their areas of interest are, to bring information about what you'd like to see them do and what your community needs are.
Okay, I'm going to go to the second question, and you made this point, but I think it's not one that lots of people are aware of, that a bank can get credit under CRA for actually providing pro bono, volunteer their staff for activities of mutual interest with a community nonprofit. For one to explore that, is that a different place one goes to in a bank to try to learn about, do they do pro bono placement of their staff?
You know, each bank is going to be organized a little bit differently, and if it's a really small bank, the CEO might also be the CRA officer and wear multiple hats. In a really large bank, they're going to have a lot of different departments. They're definitely going to have CRA staff. They might also have a separate corporate responsibility staff, and they might also have a separate marketing group that handles sponsorships of events. So you kind of have to figure that out on a bank-by-bank basis of who's in charge of what. But I think if you start with who's the CRA officer, they should be able to point you in the right direction.
Great. I'm going to go to the next slide and question number 3. We've talked about CRA is certainly about low-income neighborhoods, but it's also about low-moderate income populations. Can you explain maybe further, at this point, do bank examiners evaluate access to investments, lending, and services for discrete subpopulations, or are they looking at it broadly at LMI? This certainly, in your comments you've made today, was one of the points that the Fed and OCC, it appears to be looking at, that LMI is not one homogeneous group of people. There are subpopulations like people with disabilities. So I guess the question is, today are they looking at that, or is that something really that might need to happen in the future pushed under modernization?
So there's nothing in the current rules or practice that I'm aware of that requires examiners to look at specific subpopulations like people with disabilities in the LMI group. But if the community contacts or the information in the CRA file or the information that the bank and the regulator have about community needs or about performance context shows that there is a need to serve people with disabilities and a mention of, specific products or services or activities that would be good to meet those needs, then that's a way how you can start to try and make it part of the exam process. So there's nothing in the rules currently except that the examiner must look at the performance context and community needs. So what you want to do is make sure that those needs are reflected in the CRA file, in the comments, in the information that the banks and the examiners have.
Yeah, excellent. I'll go to the next question, and then I'm going to go to Mark with some further questions. Next question is, currently, is data available from regulators or banks on what has qualified for CRA credit? And if so, how can you access that data?
So it depends on what kind of data you're talking about, right? So even before the CRA was enacted by Congress, Congress passed the Home Mortgage Disclosure Act, or HMDA. HMDA requires both banks and non-bank mortgage lenders to report on both applications and originations of loans. And it's a hugely valuable resource. It's publicly available. It's very important. So HMDA data is available and is used as part of CRA exams. There's a less broad set of data available about small business lending. In the small business context, only banks over the $1.284 billion asset threshold are required to report data on small business lending, and they're only required to report originations, not applications. Some smaller banks voluntarily report that small business data, but again, it's only originations, not applications. And none of the non-bank lenders, like all of these fintechs, are required to report small business lending data. So that's much more limited, but there is some publicly available, and we've used a lot of that publicly available CRA small business data in a series of research reports that are on Woodstock's website. And what they show is, a decline going back from before the Great Recession until now of bank lending to small businesses. And particularly and disproportionately in low and moderate income communities and in communities of color.
Interesting. I'm going to take it to Mark to follow up on this data issue.
Sounds good. Dory, thank you so much. What a tremendous presentation. And as you and perhaps our listeners, folks tuning in, might well suspect, given the focus of the Center on Disability Inclusive Community Development, we are keenly following the developments, many of which you so expertly mapped out in so-called CRA Modernization and the like, and of course you've touched on a number of the proposals. But the question I have is sort of a follow-up to the one, Michael, that you were just asking, has to do with data again, and that is, are there significant changes that federal regulators might make that would make more data available to assess a bank's CRA performance? And particularly, I would add as a coda to that, to assess a bank's performance with respect to investment lending and service for people with disabilities.
So I think with regard to small business lending data, the Dodd-Frank Act created the Consumer Financial Protection Bureau and gave it authority under Section 1071 to issue rules that would require collection of small business lending data that would include more data points like gender and race of the borrowers and applications and things like that. Unfortunately, under the current administration's leadership at the CFPB, they have not moved forward with the rulemaking under Section 1071. We think it would be very helpful if they did it in a good way. So there's authority to collect more data. It's not happening yet. Under a different Congress, you could potentially pass laws to require more data collection and additional data points, and that's one of the things that the Warren bill would do that I mentioned.
Yeah.
I think under the current CRA modernization process, it is pretty unlikely that the rules will result in more data collection because the administration's idea seems to be less regulation, less data collection, less burden on banks.
Understood. Did you want to
I
have
would
a
add, Michael again, though, you know, in the discussions, very unique discussion we had last week, about 14 of us with OCC Commissioner Otting, a part of what he shared, and again, I think this is certainly a position of his, doesn't mean necessarily it will be accomplished, but I liked what he had to say, which is that more data should be available. The whole CRA process should be more transparent. The public should be more aware of what banks are getting CRA credit for, and then more on knowing by area, you know, by region, geographic area, and certainly there's debate about defining area and region, but that more information be available on just as you had described, that could only come from more disclosure of data. There's certainly a give and take here. I think there certainly in those of us who work in the low moderate income communities and supporting people in those communities, more data would be helpful. Banks I think have been on record, at least some banks, is we don't need more regulation disclosure. We need more transparency in terms of what the regulators want, and so it goes. But
yeah, I would agree with you, Michael. But I would say though that what I heard in the OCC meeting is not so much that the OCC was proposing to share more data or collect more data, but to have more clarity about what counts and where it counts and how it's measured for CRA. But that's different than collecting more data.
Right. Well, we will next month have in our monthly series individual representing OCC and an individual representing the Federal Reserve, and we'll probably get into these issues further at that time. But let me bring it back to Mark.
Okay, thanks so much. Again, Dory, thanks so much for your coaching and encouraging our community to be much more involved in the CRA process. And I guess my next question to you is, perhaps if you could just elucidate a little more, explain a little bit more about what is most helpful to include in written comments that are submitted. I've spent a lot of my career, over 25 years, encouraging folks to, write your member of Congress, reach out to your policymaker, and the devil's in the detail about what you want to include in those kinds of communications. Maybe you could talk now, if we're talking about reaching out to banks and providing comment in a written form, what kinds of concrete things would we as representatives of the disability community or community-based organizations want to weigh in specifically on in those written comments to banks?
Sure. I think you would want to outline, what the community needs are, specifically relating to mortgage lending, to small business lending, to branches, to ATMs, to accessibility, to specific products, services, types of grants that are needed to support the work that your organizations are doing. And if you have data to back that up, that X many people with disabilities are unbanked, or X many people with disabilities, don't own a home, or X number of people with disabilities need a home modification, whatever it is, try to provide data and as much specifics as you can. And then also, based on what you know about the bank's performance, either based on its CRA exam or other information from the community, anecdotal information is fine, discuss how well or not the bank is meeting those needs. And then, talk about what specific actions or products or services you want to see going forward.
And this, I think, feeds directly into my next question, which is the concept, and we've talked about it a little bit today, and certainly in our first, the inaugural webinar in this series in launching our center, the concept of performance context. And it's a term of art referring to what a bank, the context in which a bank is operating, and it's a rubric against which a bank's CRA performance is measured. Maybe can you just talk a little bit more about how a performance context is established for a bank? Is it consistent over the course of time, and quite frankly, how it sort of figures into a bank's performance evaluation?
Sure. So under the CRA regulation, the performance context is a broad range of economic, demographic, and institution and community-specific information that an examiner reviews to understand the context in which an institution's record of performance will be evaluated. So each of the regulators may do this slightly differently, and they'll do it differently based on the asset size of the bank for small, intermediate, small, or large banks. But basically, they'll look at the institution, what's its business strategy, what kind of products does it offer, what's its asset size, what was its past CRA rating, what things were identified as areas that should be improved on. So that's all the bank stuff. Then they'll look at the community profile. That's where the community needs come in, including the local market conditions, levels of employment, small business conditions. And this is where you can feed in information to the examiners and to the banks of what that community profile is, and make sure that the needs of low-income people are reflected there. Then there's also a look at the bank's assessment area. So that's the geographic area in which the examiner is going to look at the performance. They'll look at the demographics of the area, what's the population of low and moderate income people, what's the racial and ethnic makeup. You could add in information about the population of people with disabilities, what are the economic conditions, and then they'll also look at things like comparison to peer financial institutions or similarly situated banks, and see, if other banks are, for the most part, doing X% of assets as investments, and this bank that you're looking at is far below that, then they'll say, that they trail their peers on investments. Or if they're dramatically exceeding their peer banks in the amount of small business lending or mortgage lending, then they'll say, well, they get an outstanding rating in that category because they're vastly exceeding their peers. So it's all about the context. And that's why I'm so concerned about some of the CRA rule change proposals that really lower the importance of community profile and performance context and make it more just about the dollar amounts as the first look.
Great. Thank you for that. One last question for me, and then I think we're going to move on. And you've touched on it a little bit. So many banks, the vast majority, are receiving CRA ratings of satisfactory or outstanding, well over 90%. Given that, and our focus here at the Center for Disability Inclusive Community Development, talk for just a minute about what you think the best, or if we're going to hone our energies on trying to attract banks to do more in the way of disability inclusive community development, how in that environment where the vast majority of banks are already getting satisfactory ratings, how can we be most appealing to them and make the most difference?
Again, there might not be one silver bullet for every bank you're dealing with, but one thing I would suggest is if you can't get a bank member to serve on your board or in some volunteer capacity, at least find someone inside the bank who can be your internal champion, who really is committed to your issues and understands it and will fight for what you want to fight for from the inside. That's one thing. The other is just, to use these available processes of submitting comments, submitting data, meeting with banks, meeting with regulators, and educating them about both the needs and the opportunities. And I would say try to emphasize the win-win whenever you can, not just how can you help meet my needs, but how can I help you do what you need to do, whether it's to get good reputation, public recognition, CRA credit, media coverage, more CRA loans, more deposits. Try to find the win-win.
In the interest of time, I'm going to skip some of our thoughtful questions and move to, because we just have a minute or two left. Dory, in closing, if you're a nonprofit new to exploring this whole CRA area and collaborations with bank, can you give people concise 3 steps? What would you do first?
Well, one is learn about CRA. So I suggested join NCRC, meet with local NCRC members, attend the conference, look at the websites I mentioned, educate yourself. Second, become familiar with the particular bank's latest CRA exam, meet with their staff, meet with their regulator, learn about their performance and their priorities. And then third, prepare to have a discussion and an agenda and come armed with your data and your specifics of what your needs are, what your wants are, whether you think the bank's meeting those needs, and if they aren't, what you want them to do.
Fantastic.
Thank you so much.
All right. In the interest of time, we're going to not go to further questions. I want to first thank Dory. Just a wonderful presentation and a wonderful dialogue with Mark and me. So much to be learned about CRA, but an obvious place if you're in the disability community, whether a nonprofit, an entrepreneur trying to secure funds for a small business, interested in expansion of housing, wanting to focus on financial literacy, and so many other areas. Dory, you've given us really a lot to think about and a roadmap to move ahead. In addition to thanking Dory, I want to bring everyone's attention our last slide, that our September webinar, September 18th, the role of federal regulators in bank monitoring to meet the requirements of CRA. Very pleased to bring two individuals who are experts. Jessica Farr, Manager of Examinations with the Federal Reserve Bank of Atlanta, and Paul Ginger, Community Affairs Officer with the Office of the Controller of the Currency and OCC. Please keep an eye out for the registration link. Visit our National Disability Institute website, where you can find more materials and resources from our new Center on Disability Inclusive Community Development. So once again, thank you for joining us. Thank you, Mark, for helping me with these questions. And we're excited. This is a marathon. This isn't a sprint. We are learning, and by learning, we're going to become more active in the conversations happening at a local, state, and national level. So thank you all for joining us, and please do look for the information coming on the next webinar in September, where we'll have a direct dialogue with two of the three bank regulators, and it should be, again, helping all of us move ahead in our depth of understanding and move from knowledge to action. So thanks again for joining us. We look forward for you to share this new resource, this new center's activities with others, and hope that you come visit our website and learn more about CRA and inclusive community development for your future activities and future activism in your local community. Have a great afternoon. Take care.